This video is because I'm seeing a lot of opportunity for you guys to do HELOCs now, which is awesome. Love HELOCs, very cool. The one reason I'm coming on here is because HELOCs are not necessarily appropriate for people in retirement years. And so I'm all about reverse mortgages. I want to show you guys something that will arm you to be able to do more reverse mortgages and not put seniors into a HELOC when it's really not the best option. Because a lot of you guys aren't aware, there is something called a RELOC, reverse mortgage line of credit, equity line of credit. And that's part of the regular reverse mortgage, either a HECM, some of the proprietaries have it as well. But I want to go over a couple of things so that you're armed with why a HELOC is not appropriate for someone in retirement years in general. There's going to be some exceptions, of course, but in general, there's some big pitfalls when it comes to HELOCs in retirement years. So let's start here. So HECMs have advantage over HELOCs for homeowners age 62 and up. I just brought this graphic up because it makes the conversation a little easier. So HELOC, home equity line of credit, different than a reverse mortgage equity line of credit. That's a FHA reverse mortgage we're going to talk about right now. So HELOCs can seem like an easy answer. They're cheap, they're easy, they're real simple to put in place, and they actually target seniors for marketing. Why it's not a good idea? Because the reverse mortgage line of credit can be hugely more beneficial. Why is that? Couple of things. So some features that you're going to see, the HECM versus HELOC. So the HECM, you keep title to the home as owner. We're all mortgage people. We know that. A lot of our consumers don't know that. They think when you do the reverse that suddenly the bank owns the house. Not true. It's a lien on title. Same with a HELOC. No big difference there, right? Here's where the differences come in. A HELOC requires a monthly payment. Now, this is one of the main reasons why it's not appropriate for retirement age people. So a regular HELOC is going to go, and the ones you guys are selling, I think will work like this. Put in the comments if it's not, educate me on the HELOCs because I don't do them. I don't do regular loans. But the typical HELOC I'm familiar with is it will go for 10 years. And they can draw on those funds for 10 years. So let's say somebody gets a line of credit for $100,000. Well, on average, people actually use all of their HELOCs up in 6 years. So let's take a 70-year-old borrower who had enough equity, they had enough income to qualify. So you just throw them into a HELOC, real simple, easy answer. That's what they asked for. That line of credit, they're going to exhaust likely within 6 years. They're going to have a monthly payment that's interest only up until year 10. Now at year 10, that loan that they borrowed is going to re-amortize, and now they've got to pay back interest and principal. Someone in their 70s is not more likely to have higher income in their 80s than they did in their 70s. In fact, typically on fixed incomes, the spending power goes down over time, and they just can't keep up with the cost of living. So what you actually do with a lot of the seniors who do HELOCs, they're either you guys are doing it, the clients are doing it, whatever, it's setting them up for a lot of failure. And it's a really simple Band-Aid solution. It's easy, it's cheap, it's quick, which is the result too for their retirement. Now, the problem we see a lot is that people will go and do the easy, cheap, quick solution. They'll go and do a HELOC. And then once they've exhausted those funds, well, they can't make the payment. And so now they're looking back to the home to say, okay, how can I get more equity out? And they come to us, reverse mortgage people. You guys are out there doing it yourself. You've probably seen this. When you run those numbers, a lot of the time they borrowed too much with the HELOC and now they can't qualify for a reverse mortgage. Those borrowers have to sell now, or they're just really stuck in a horrible financial situation for the rest of their retirement because their loan officer didn't bring up this other option. Either one, because they don't do them. That's a common one. It's not commonplace. They don't know enough about them, or they just don't see the opportunity and understand that this is a better solution. So that's why I'm coming on here today to help you guys understand this is a better solution. Monthly payment is required. On a reverse mortgage line of credit, there's no required monthly payment. They can make payments should they want to in any amount at any time. Most people don't, but if they do, this reverse mortgage line of credit will grow and not grow depending on the situation they're using it. Either they're going to borrow it all the way down to zero and then nothing grows, or they're going to leave some on the line of credit and that actually grows. So a couple other protections here. The line of credit is protected from being frozen by a lender. So we saw in 2008 when the real estate market crashed, Lenders froze their HELOCs. Well, everybody who had a reverse mortgage line of credit instead was happy as a clam. Their HELOC, their line of credit was not frozen. The line of credit actually grows without them having to do anything. We're going to see an example of that in just a second. You can draw from the LOC for more than 10 years. If they have this reverse mortgage for 40, 50 years, they can draw on that line of credit as long as there's still funds available. And with the growth feature, a lot of people will still have funds available. And they don't incur a payment when they borrow funds. It's insured by the FHA, huge, and the loan is non-recourse. If you were to be upside down on a HELOC, you would still owe that money. If you're upside down on a reverse mortgage LOC, you actually don't owe that money back to the client, or reverse mortgage, the loan balance you'd be borrowing and it'd be adding to the loan balance. So just in general, keep this in your mind. The reverse mortgage will have a line of credit that grows. Now, what that is increased access to people's equity without having to refinance, without having to requalify. They just expand the borrowing power over time. HELOC doesn't do that. HELOC, it's 10 years straight, and then for the next 20 years, well, you better make that mortgage payment. We're going to have some problems. That's one of the reasons reverse mortgage line of credit is absolutely better for retirement age people, because there's a lot of life events that happen during retirement. There's falls, there's medical diagnosis, there's just finances get really tough. There's businesses that close. There's adult children that need help. There's just a lot more life events. And if you can protect them from having to sign up for another monthly payment, you can protect them for the long term. And that is one of the biggest powers of reverse mortgage. Now, before we jump off here, I'm going to make this really brief, give you an example. I'm not going to go over the details of the loan for this purpose, but I do want you to see the line of credit growth feature. So this is our amortization schedule. If you guys are not familiar with this yet, if you're doing reverse mortgages, you need to quickly become familiar with this. For the forward side, I know you guys don't see amortization schedules a lot in what you do, but for the reverse side, every single client I present off of this form. You're going to see the line of credit here, it actually grows. Now, if they borrow it down to zero, it's not going to come back unless they make payments. Now, if they make a payment, it will dollar for dollar add to the line of credit. So that's a nice feature as well, is that you're not setting a senior up to have a one-way window on payments like a HELOC is. Well, for after the 10 years, right? After 10 years, it's not an open window. And there's a required monthly payment. So with the reverse mortgage, they can pay it, they can take it back, they can pay it, they can take it back. And if they just leave it, in this example, this is what we're showing, is that this person set up a line of credit through the reverse mortgage of $212,000, and they left it. And so it grows. Look at the power of this thing. Let's just go 10 years out. 10 years out, this line of credit, assuming they haven't drawn anything from it, will have grown from $212,000 to $359,000. Now, these are estimates because the interest rate can adjust. About 90% of reverse mortgages are adjustable rate, open-ended loans. And so that's how we create this line of credit option. But how beautiful is that? That's gigantic. Let's take out to year 16. And I know these ages sound crazy to you guys, 97, they don't sound crazy to me. I have a client that's 102 right now doing a reverse mortgage. These people live a lot longer than they think they're going to. So the line of credit will have grown to $511,000. That's amazing in 16 years. Now, the cool thing about this is now the really cool thing is at year 16 on a HELOC, they could never borrow this. But on a reverse mortgage line of credit, it's available to them. Now, the really cool thing is, let's say this 97-year-old decides that, I need in-home care, I need a little bit of help. They can call the mortgage company and say, hey, I want to turn my line of credit into equal monthly payments so I can pay for the care that I need. Now, in-home care, right? They have to be in the home as a primary residence. But they can call, and at that point in time, the servicer will calculate some numbers, figure out how much a monthly payment they could do to that borrower. So now it's coming in every single month without having to do anything. They don't have to fill out the paperwork to draw on this line of credit regularly. We can switch formats, and now they're just getting deposits every single month to the bank account of their choosing to pay for that care. So the power of protecting people long term is immense. It's amazing in reverse mortgages. That power is not there with HELOCs. So please, 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 the next time you're looking to do a HELOC for a borrower that is over age 62, message me, message your AE, just get a quote, bring it up. Understand how this stuff works, because this is such a better option and most people don't understand that it's even out there. And I'm hoping to empower you guys to help bring awareness to this product, because it is just so powerful in retirement. All right, message me if you have questions. I'm happy to support all you guys brokers in here, and I'm a broker myself. I love this product. Just coming out to spread awareness. Have a good day.